Welcome back. And now let's get some global perspective. Jameel Ahmad, Global Head Currency Strategy and Market Research at FXTM UK, joining us for a sense of how things are shaping up. Jameel, thanks so much for being with us. If we take a look at, really what's going on currently and the fact that U.S. markets continue to trade at records, trade tensions do seem to be easing off. And we have already seen an impact, of course, on bond yields and currency. But how do you think things will shape up from here on?
Thank you very much for having FXTM. Generally, I see a lot of complacency here and also a sense of deja vu, because investors have done this before. They've turned their back on trade tensions. They've turned their back on what impact this could really have on investor sentiment, and this has helped U.S. stock markets. But if you look at that New York speech yesterday from President Trump, this is nowhere near yet at the finish line, which means there's trade tensions between the US and China could get worse. So I see that emerging market currencies here are standard at risk of risk aversion when investors do not want to take on risk appetite. So I would look at the Chinese yuan, the Indian rupee, and the South Korean won, along with the Malaysian ringgit, as the currencies that are going to be impacted from potential risk if things do escalate. Whereas the Australian dollar and the New Zealand dollar will also fall into this basket. Where I see opportunities is in gold and the Japanese yen. I think the US dollar, Japanese yen approaching 110 is a very good opportunity to look at Japanese yen buying, because we know how much of a safe haven yen is. And again, US stock markets, you pointed out very correctly there, there is no explanation at all for the Dow Jones and the S&P 500 to be at above 12% 2019. At the same time, gold has climbed by close to 15%. Something's got to give here. So if we do have a US market sell-off before the end of 2019, I do see opportunities in safe havens.
Jameel, you just talked about the INR, and the Indian rupee has breached the 72 levels just a short while back for the first time since September this year. What is it that you sense the rupee would do in the near term as well as the medium term? Because, as you would know, besides the impact of the dollar that the dollar actually has in the Indian rupee, we have our own internals as well. Less elbow room with the Reserve Bank, the central bank that is, and amidst that, we are in an economic slowdown. And, more and more people predict that the GDP print is even going to fall below the 5% mark.
Yeah, global growth concerns here. There's a lot of global growth concerns. We cannot stress that enough. The IMF, the World Bank, the OECD, and so on, have been shouting about global growth story for 2019. Emerging markets are only just starting to take this seriously. India is at risk of falling below 5%. China is going to be at risk of falling below 6%. We saw the IMF cut growth forecast substantially for the GCC and Saudi economy just over a week ago. South Africa is the exact same story. Generally, I do see that the Indian economy will continue to outperform against its peers, but the markets have got way ahead of themselves when it comes to Federal Reserve US interest rate expectations, that US interest rates will continue to cut lower. So this is strengthening the US dollar. And while investors do not get the clarity that they really want, that US and China are close to becoming friends again, this is going to strengthen the appeal of the US dollar, weakening attraction towards emerging market assets, and the Indian rupee will fall into the firing line. The global backdrop right now is not positive for emerging markets when there's no signs of a US-China trade deal. So I do think investors will stay away from emerging markets because of this. And of course, that news at the end of last week regarding the downgrade for India, that's just weakened the rupee sentiment, even further.
And just to take that point further, Jameel, with that Moody's report coming in, and we've got further data out this week as well, and again, warnings with regards to the GDP picture and so forth. Are investors worried about the macro picture? If there was to be money moving towards emerging markets, where would India really stack up?
Well, the thing is, this is where the larger picture, India's growth story, even if it's trending lower, is significantly above other emerging market peers. You look at the United States and developed markets, its economy will grow by 2% in 2019 and potentially another 2% in 2020. Both Europe and the United Kingdom will be lucky to get growth at 1% over 2019 and again in 2020. India will grow by 5%. Even if it dips to 4.7, 4.8, it's going to be double what you see in advanced markets. The same to say for China as well, even if it does trend below 6%. When it comes to other emerging markets, Malaysia should grow above 4%. We expect the Indonesian economy to recover in 2019. But India does have scope for fiscal reforms. It also has scope for central bank easing should the global backdrop deteriorate further. And this is something that I think that central banks in emerging markets need to be more aware about. I think a lot of activities being at play in 2019, over 30 interest rate cuts altogether this year. But if the Federal Reserve are cutting US interest rates 3 times in 2019, despite the US economy remaining very strong when it comes to advanced nations, they are that concerned about US-China trade tension. So all of the emerging market central banks should consider more action.
Okay, what kind of action do you would you anticipate, Jameel, or factor in, on the hopeful side?
Lower interest rates. I really do see more scope for lower interest rates in all of the emerging markets. Maybe stretch across Turkey, China, India, Russia. I see lower interest rates still at an advantage for emerging markets. US interest rates now are below 2%. They can't cut them that much further. And don't get me started on Europe. We've got record low interest rates. In fact, they're just going to make more history and more history by cutting interest rates even further. The Bank of England and Brexit, it's such a perilous for the United Kingdom economy, but the Bank of England can't do anything until Brexit is over. But emerging market central banks, if you look at what the scope is of policy, they can still cut interest rates by up to 50 basis points, another 1%. And I do think this is activity that they really can consider because inflation is not that high right now in the emerging markets, which is a surprise considering the currency weakness that emerging market currencies have experienced against the US dollar over the past 18 months. So this suggests to me that there is scope, there is action. That corporate tax cut, though, will in time help the Indian economy. We need another 3 to 6 months to see what impact the corporate tax cut down towards about 25% will have on Indian corporations and investments.
Okay, just finally, Jameel, and on a lighter note, what did you make of Trump's commentary yesterday attacking the Fed once again?
There's no real surprise here. I think we could have the same interview 2 weeks from now, 2 weeks in the past, and 2 months away from now. There's the same old narrative. You never know what's going to be expected. You never know exactly what he's going to do next, but you do know that he will continue to impact and attack the Federal Reserve and their chair, Jerome Powell. Again, investors will take this more easy because it's something they expected before, but central bank independence is a critical issue for investors nonetheless. You only had to look at what happened on the Turkish lira in 2018 to know what a serious risk it can be. At the moment, investors are taking their stride because they're so focused on US and China trade.
Jameel, good to have you on the show with us and share all that perspective on which way market and in particular currencies may be headed.